Your renewal notice came. Same car, same house, same you. No accident, no claim, nothing you did differently in 12 months. And the number went up. So you assume somebody decided to charge you more. That is exactly what it looks like from where you're standing. A letter arrives, a number is bigger, and there's a company at the top of the page. I want to take that letter apart, not to defend anyone. By the end, you'll have a better reason to be angry, aimed at something real. Start with the size of it, honestly. Since the end of 2019, the price of car insurance in America is up about 50%. Everything else, all items together, went up about 30%. So it didn't just rise, it rose about 20 points faster than the world around it. The worst single stretch peaked in April of 2024, when car insurance was up more than 22% from the year before. Here's the part almost nobody tells you, so let me be the one who does. It stopped. As of the most recent data, car insurance is about 4% cheaper than it was a year ago. It has been falling for months. And you don't feel 1 cent of that because a price that stops climbing is not a price that comes back. The rate went to 0 and below. The level stayed. That gap between it stopped getting worse and it went back is where most of the anger in this economy lives. So the real question isn't why it's going up. It's why it went up that much when nothing happened to you. And if you want the mechanism instead of the outrage, that's what this channel is for. Let's start with the fact that breaks the obvious story. There are fewer crashes, not slightly fewer. Through most of last year, the number of repairable claims fell more than 10%, and total claim volume fell more than 8%. Fewer accidents, fewer claims. Frequency has been drifting down for years, and the premium went up anyway because you were never paying for how often things break. You were paying for what it costs to put them back, and that number went somewhere else entirely. Now, when people hear repairs got expensive, they picture parts. A bumper costs a fortune now, right? The official price index for auto parts is up about 1.5% over the past year, and about 28% over 7 years. General inflation over that same 7 years was about 30%. Parts are not the story. Parts are inflation. Labor is the story. Mechanical repair labor is up more than 70% in 7 years. And not because mechanics got greedy, because the thing they're repairing changed underneath them. Your bumper is not a bumper anymore. It's a sensor housing. Your windshield is a camera mount. And every time one of those gets touched, the car has to be recalibrated so that the automatic braking doesn't aim at the wrong part of the road. In 2022, calibration showed up in about 12% of repair estimates. Last year, it was in almost 35%, nearly 1 in 3. When it appears, it adds around $700. And it adds days. A repair with no calibration takes about 13 days door to door, with one over 15, with several more than 17. Every one of those extra days is a rental car, and the insurer is paying for it. Then there's the quiet one. Last year, 23% of all auto claims ended in the car being written off completely, the highest share ever recorded. And more than 70% of those write-offs were vehicles 7 years old or older. That's not carelessness. That's arithmetic. The American car fleet is now about 12.5 years old on average, and there are roughly 12 million fewer nearly new vehicles on the road than there were in 2020 because of a production hole that never got filled. An older car is worth less. Repair costs are worth more. Cross those two lines, and the car doesn't get fixed. It gets replaced. Replacement is the most expensive outcome there is, so fewer accidents, each one dramatically more expensive to close. That's half the letter. Here's the other half, and this is the half you were never shown. Your insurance company buys insurance. They have to. No company can hold the risk that a single hurricane wipes out an entire region in one afternoon. So they sell that tail risk onward into a global market, and the price of that protection is set once or twice a year by what happened everywhere. Between 2018 and 2023, the cost of that protection in the United States roughly doubled. At the start of 2023, one benchmark for catastrophe coverage jumped more than 27% in a single renewal. That's the shock that reached your mailbox about a year later, and it isn't a small slice of the bill. One study, built on tens of millions of actual escrow payments, found that more than a quarter of the real increase in what Americans pay for home insurance traces back to that one input, not your claim, not your street. The price of protection bought in January in a market you've never heard of. Which is why disasters matter even when they don't happen to you. Insured catastrophe losses worldwide were about $107 billion last year. That was down almost a quarter from the year before, and it was still the sixth straight year above $100 billion. The long-run trend rises around 5 to 7% a year after inflation, whether or not your year was quiet. One fire event in one city produced about $40 billion of that by itself. You're in the pool with all of it. Now watch what that pooling does to the map, because this is where the word average starts lying to you. Congress's own auditors looked at home insurance from 2019 to 2024. Nationally, after inflation, the average premium rose about 3%. 3. If that number feels insulting, it's because the average is describing two different countries. In parts of the coastal South, the real increase was more than 25%. A house in a severe wind risk zone pays about 58% more than an otherwise identical house somewhere calm. Roughly $1,300 a year for the weather. The Federal Insurance Office ran the same question across 246 million policies. The highest climate risk fifth of zip codes paid about $2,300 a year. The lowest risk fifth paid about $1,277. Same product, 80% apart. And those high-risk zip codes weren't only paying more, they were being dropped more, at nearly twice the non-renewal rate. There is no national price for this. There's a map. Which leaves one last piece. Why the increase arrives all at once like a punishment. Insurance rates are approved state by state before they can change. A regulator has to say yes. In one large state, a home insurance rate took a median of 305 days to get approved. And until the very end of 2024, that same state was the only one in the country that forbade insurers from citing the cost of reinsurance to justify a rate at all. Think about what that does. The cost rises in real time. The price is only allowed to move in a step after a hearing later. So the increase you finally get isn't this year's increase. It's several years of increase delivered on one page. And where a regulator holds hardest, insurers don't discover cheaper risk. They write fewer policies there and charge more where the process is faster. One estimate puts the amount shifted onto consumers in low-friction states in the billions over the next decade. Now let me argue against myself because I'd be lying by omission otherwise. 2/3 of American homeowners say the main reason their premium went up is insurer profit. And last year, home insurers collected about 12% more in premium while paying out about 10% less in claims. That is a very good year, and it is a matter of public record. So no, the industry is not a charity that merely passes costs along. When pricing lags a cost spike, it also overshoots on the way back. What it doesn't do is set the cost of a wildfire, or the price of recalibrating a windshield, or the number of days a regulator takes to answer. Which brings me to the part that should genuinely bother you. How much of your premium is actually about you? Around 95% of car insurers use a credit-based score where they're allowed to. Take one driver, clean record, minimum coverage, and change nothing except that score. The national average goes from about $470 to about $700. In one state, the penalty for bad credit runs over 260%. In most of the country, a driver with a perfect record and poor credit pays more than a driver with a drunk driving conviction and excellent credit. The Federal Trade Commission studied this and reported two things at once: that the score does predict claims, and that they could not explain why. And here's the number that finishes the thought. Almost half of all car policies were shopped in the past year. A record. People who actually switched saved a median of about $460. People who agreed to let a device watch how they drive, every trip, saved a median of $120. Changing companies is worth roughly 4 times as much as changing your driving. That should tell you exactly what the price is measuring, and this stopped being a nuisance a while ago. Insurance is now about 14% of the average monthly mortgage payment, up from 10% a decade earlier. The Dallas Fed estimates premium increases alone pushed roughly 31,000 mortgages into default in a single year and projects hundreds of thousands more per year going forward. Meanwhile, 17% of lower-income homeowners now carry no insurance at all because the cheapest way to survive a premium is to stop paying it and hope. So here's where I land. Your premium is not a grade. It isn't a report card on your driving or your maintenance or your character. It's the price of a pool you were sorted into, by a zip code you chose for other reasons, by the average age of every car on the road, by the cost of labor to recalibrate a camera you never asked for, by a fire in a city you've never been to, and by how long your state takes to say yes. Nothing happened to you. That was never the input. Because insurance was never pricing what you did. It prices what it costs to put things back.